this video, we're going to do kind of a hodgepodge of some smaller things. And then we'll wind up with looking at reports in the final video. So oftentimes we will extend sales discounts to our clients who are purchasing things on account if they pay us within a certain amount of time. And so hopefully you remember from your prior accounting classes phrases like 210 net 30. So that means a 2% discount if somebody pays within 10 days and the full amount is due within 30 days. And so you want to make sure that this is automatically set up in your accounts when you're selling your items so that when the money shows up, the discount is automatically applied as long as it's paid within the window that the discount is allowable. So many of the more common discounts are preloaded into QuickBooks, and all we have to do is just associate them with the sale or the customer or whatever. Sometimes we may want to add our own customized discount terms, and so QuickBooks gives us the opportunity to do that. And so when a customer pays us within the discount period, we're going to go to the receive payments just as if they pay us at any point, whether or not it's within the discount period, and we'll enter the date and the payment method, because while it will default to today's date, that may not necessarily be the date the customer paid us. If for some reason we're a little behind in doing our deposits and our entries and stuff, they may very well have paid us within the discount period, but by the time we got around to doing the entry, that time period may have gone. And we don't want an unhappy customer calling us saying, hey, I paid you, why didn't you give me my discount? So we're going to make sure that we choose the date that the payment was entered, and then we're going to apply it to the particular invoice. And then we're going to click on the discounts and credits button, and then we're going to make sure that, and I will hop over in a second and show that, and ensure that the appropriate amount actually gets applied. So it will automatically know, okay, this is within 10 days, so what kind of a discount should they have gotten? And this QuickBooks will say, well, you should have given them this. And so then this gives us the opportunity to confirm that this is in fact the discount that we want them to have. And this is the customer payment window that will allow that to be clearer. And if you happen to screw up on a payment, you can either edit it and fix it or delete the payment, but make sure that you then start over and actually record the payment. So, and again, here's our discounts and credits tab. And so we'll go over and take a look at that. And so we're at our customers window. Somebody had bought something on account. Now they're going to pay us. And so we want to make sure that we now go down past the other items we've done to our received payments. Okay, and so enter this. And now this customer doesn't have a particular, there's no data in this. This is just the stock file for this this chapter's assignments. And so there are no invoices in here and nothing associated with a discount. But if there had been, these fields, well, this one in particular here that's grayed out, this would be the place that we would access the discounts and credits in order to apply that customer's discount. And so again, we've done this in prior chapters, so I'm not going to spend a lot of time on this. Sometimes we need to make adjustments to our inventory count. Despite our best efforts, what we are able to sell in terms of our inventory may not be the entire inventory. It turns out maybe something got lost, broken, things become obsolete and we can't sell them. If we're an electronics company and we had VCRs in inventory, it's probably time to retire those from our inventory. And so we would need to make adjustments to that to show. I mean, I think rarely would we show that we have more, but I guess it could happen if we made a mistake when we were doing the initial entry, that it would show us that we have more than we think we have. So the entry that would be going on in a manual accounting system, if we were going to do an adjustment to our inventory, is that we would have our inventory adjustment account, which is the loss or expense, and that would be a debit. And then the inventory, which is our asset account, would receive the credit. And that's what QuickBooks will do behind the scenes. So in order to you're going into the vendors and the inventory activities, and then you're going to adjust your quantity on hand, and then well, we'll just hop over and do this. It's just easier. But we'll look here at the slide that shows that, and then this allows us to enter the new quantity. This tells us what it thinks we have. This, we tell it what we actually have, and then it makes the reduction. And then similarly, it will make an adjustment in the value of the inventory. And this is something that we can manually adjust if for some reason we need to do that. And we would want to make some sort of a reference here just so we can keep track of adjustments that get made. We shouldn't just sort of willy-nilly be doing that. And so I'm going to stop here and we'll go over and adjust some inventory. And vendors, and we've got our inventory activities, and this is how we get to our inventory center, but we can also adjust from here. And now, because again, there are no transactions in this data file, it shows that we don't have any. But this would be an opportunity for us. This is not, again, where we would want to enter the acquisition of new inventory, a purchase or something like that. We still want to make sure that we do that through our either our write checks menu or our enter bills menu. Come to the end of our taxing period for our taxing authority, whether it is, you may have taxes that are due quarterly, monthly, some other time period in terms of sales tax, or again, this could be applicable to rooms and meals. But now we have to actually pay that tax. And so the two accounts that are going to be impacted will be, of course, credited to show the decrease in cash. Sales tax payable is debited to show the payment of the sales tax. And so these are the journal entries that QuickBooks is going to be making behind the scenes for us. And so in order to pay the sales tax, we're going to click Vendors, Sales Tax window, and then at the submenu, Pay Sales Tax. We're going to choose a window, because generally beyond the period, so let's say we're paying it for the first quarter of the year. So that's January 1 to March 31. But we might not actually be sitting there doing this until April 10th, or, depending on when, what the deadline is for the filing of the return and making the payment. So what we don't want to do is we don't want to select a window that includes all the way up to our payment date if the sort of the tail part of that is after the relevant period that we're remitting the tax on. So we want to stay true to the period that this tax is being collected for and make sure that we show sales tax through the particular date, which is the end of the period for the remittance that we're currently making. And so we're going to put a little checkbox in there. And so you'll see, because you will probably have collected tax beyond the due date that's here. So if you were to extend that out, this number would get bigger. But hopefully QuickBooks is smart enough to know, well, we know it is, that if you put the ending date here, QuickBooks is only going to include the tax from the sales that occurred up through that date. And then we assume that you're going to print the check, unless you're going to write it manually, or do an electronic payment, which is becoming more and more the way that those payments are made. And then you're going to click OK. And that will cause that. So I'm going to jump over. We'll go do that in the live version, and then I will jump onto the last video for some reports. So to pay that sales tax, we're going to go up to our vendor window on the toolbar, scroll down to sales tax, and this gives us a number of options, but what we want to do is pay it for this activity. And it's going to default to the account that we're paying it from, which is our operating account. Now, if we were, good little doobies and we had a segregated bank account for this money so that we're not commingling it, because it's real easy to look at the bank account and go, wow, we have lots of money. And maybe you buy something or pay, but if some of that money actually belongs to the state in the form of sales tax, you certainly don't want to have that just become absorbed into your operating capital. That is a really, really fast way to get into financial distress, because then the time period comes to make that payment, and lo and behold, there's no money there to make it. So if you correctly have another account, a bank account set up that's just for that, you would make sure to select that account here, the date that the check's being written, and then make sure again that it is paying it through the date. And we don't happen to have any sales here, so it won't show anything. And so we're going to print the check, so that's going to be indicated here. We're not going to print the check. We might take that out there, and we may do, in fact, an electronic transaction rather than a check of any sort. And so that concludes this video. We'll go on to the last video and finish up this chapter.